Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. We're going to do some Twitter information. I also posted some real estate data on Twitter, so you guys can we'll all go through it together. I'll give you my financial opinion. And we've got an article as well. I'd like to kind of step through that article and at least give their opinion. I think their opinion's very similar to mine, and I'll describe why I think that. But if you want to follow me on Twitter, it is at finding_finance. It's right here. Boom. So sign up, definitely follow if you'd like, and you can see what I'm posting. And together, we'll go through it right here. So the first one I have posted up here is Goldman Sachs says go long commodities. Article below for those who want to read, you have a short read. And the title is, and I'll go over it here with you. It's buy commodities, worry about recession later, says Goldman Sachs. And obviously, this isn't advice, guys. I'm just going over what this article is. But it says Goldman Sachs did caution the path ahead may not be smooth, especially if the greenback extends its gains. If we just kind of read through it real quick, it says our economists view the risk of a recession outside of Europe in the next 12 months as relatively low. Jeff Curry and Damian Corvalin wrote in a note, with oil the commodity of last resort in an era of severe energy shortages, we believe the pullback in the entire oil complex provides an attractive entry point for long-only investments. And they go in and talk about commodities hit a record in June as Russia's invasion of Ukraine disrupted output. Snarled supply chains then eased as recession concerns flared, and central banks, including the Federal Reserve, tightened policy to contain inflation. It says, from a cross-asset perspective, equities could suffer as inflation stays elevated and the Fed is more likely to surprise on the hawkish side, Goldman said in the note, which is entitled, Buy Commodities Now, Worry About the Recession Later. It added, commodities, on the other hand, are the best asset class to own during a late cycle phase where demand remains above supply. And that, I want to read that one last time, a late cycle phase where demand, so late cycle phases always have this increasing interest rate component. They also are the last thing that works right before a recession or crash. So they have accurately identified exactly where I think as well that commodities and energy and all these things go ballistic. This could last for a few years. And I think people are very premature where you get these quotes, don't fight the Fed, don't go in an increasing interest rate. This is when things take off, guys. This is when they take off. And I think Goldman Sachs realizes that. So it says Goldman Sachs did caution the path ahead may not be smooth, especially if the greenback extends gains. A trend that makes commodities more expensive for holders of other currencies. We do acknowledge that the macro landscape remains challenging and the US dollar could rise further in the short term. And I agree with that. But in these late cycle phases, we usually see in the beginning of the phase a strengthening dollar. It happened in the beginning of the 2000s. Then a couple years it strengthened, and about 2002 we saw a flip and a reversal in the dollar. And that's when all these commodities went ballistic. I think the same thing is happening, and the setup is almost the same as the 2000s. With strengthening currency, we've had worse inflation in other currencies versus the dollar. That's why the DXY is increasing. Then I think we're going to see weakness in the dollar at some point. I'm not going to try to predict the exact point that this thing rolls over. We'll see it in the charts. And then it'll be a tailwind behind our commodities. Here's real estate. And I know a lot of people were jumping on the average sales price for new homes. They were saying that it was crashing. And what they didn't really think of, and I remain open, guys. That's why I'm so slow to move. It says the average sales price for new homes raging higher last month. Perhaps all the doom is misplaced. What does everyone think? This is the average sales price for new houses, but look, we're seeing a nice big bounce here. what's going on there? We had this nice big move. We had the sell-off. And now we're recovering in the average sales price for new houses. I thought we were just going to crash, guys. What, everyone else, oh, it's down, it's going to crash. I remain open, and I'll let the data do the speaking, but you have to have a trend. A point or two isn't a trend, but we'll see where this goes. The demographic out there is still quite good, and we're going to go over that because I posted that in another post here. It says right here, real estate, this is for August 2022, still higher year over year as expected. Some slowdown occurring. Active listing count flattening out, days on the market slowing some, prices up year over year 14.3%. I wrote, no crash yet. Here's the active listing count. You can see that we're basically not going up as quick as we were. It's flattening out. But we are up 26.6% year over year for inventory. Not a huge amount. I mean, it's an amount, but 25%, it's not that much. We are still far below all these other years. We've got days on the market. They are slowing down. That's linked with the inventory. More inventory, usually it takes a little longer to get through it, but still within the realm of a very tight market. And then the median listing price, 14.3% year over year. Yeah, it's come down a little, but I mean, it has in other years as well. Maybe not as much, but we have to see what happens next. But that's the current data that we have for August of 2022. Coming on down here, we've got Rafi Farber. He says, all-time record high physical silver premiums just hit. And this is what I'm talking about, these premiums and the disconnect from the paper market. We've got this paper market price, and then all of a sudden, the physical doesn't go down, and the premiums go up. So we have lower paper price with higher physical premiums. And it doesn't make sense to me. If the price goes down, you should have an abundance of that thing that goes down. Here's CCJ divided by URA. This is a really cool looking chart. Camco's our leader, so that's Camco divided by URA. It wants to explode here. This is John. We've got a trend line here. He projected it higher. We've got another kind of consolidation period here. And we've broken out of that consolidation period, and now we're starting to break out of the channel. If you look at like a 3.618, and I don't know if it's going to go that high, it is like off the charts, where Camco could do a large outperformance. And this is expected at the beginning of a bull market in uranium. You see your largest companies, your leaders. You see the smart money position first in things like Camco. It is positioning in it. We're seeing it in the ratios. So that's kind of the first step. The first step is the big guys take off. We should be looking where the small guys are at because they're about to take off after this. But it may take a little bit of time. So I think we're at the beginning of this big bull market in commodities. I think we're at the beginning. Well, we're not at the beginning of the beginning, but we're in the early innings. And Camco, we're in the very early innings of uranium taking off here. And we could see a big move. Once this stuff starts moving, it gets moving. So I'm buying, I'm holding, I'm ready. And I'm going to get Justin Hune on and ask him some questions and see how this uranium bull market is progressing. Looking at here, Grady, we've got this 14-year blue falling wedge tells us that things will be changing and big capital will find its way into precious metals. And I know precious metals are not in favor right now, but that is when I buy them. I buy them when everyone hates them. That is how I made all my money in oil in 2020. You got to buy things when they're down. You buy it when everybody hates it. And I'm still looking at opportunities in physical precious metals and in some of these ETFs, in some of the individual companies. I'm still looking. We haven't had a clear turning signal yet, but I'm looking for that signal. And we've got setups here where gold is going to outperform stocks. And I'm waiting for this break here, or I'm going to start loading in on this tip, not waiting for the break. I'm going to load in on the tip. That's what I've been doing. And I'm buying the higher leveraged companies very slowly, in this tip, especially physical metals, guys. That's kind of where I really like. But I'm buying physical metals down in this area, even right where we're at. So that looks good. Peter Schiff says, it's not that the Fed must cause a recession to fight inflation. It's that there's no way to fight inflation without causing a recession. In fact, because the Fed allowed inflation and leverage to get so excessive, it can't fight inflation without causing a financial crisis. And that's where their hands are tied. They can't raise interest rates high enough without causing a large problem in the system because the leverage is so excessive. And what's happening is we've got all this money in the system, and it's about to rotate into commodities, which will then be seen by the consumer price index. I'm kind of going to say they're screwed. But we know that. That's why we're sitting in commodities and precious metals, because we know the money flows are going to come over there due to inflation and higher interest rates. Here's the COMEX registered silver. Vaults dropped to under 50 million ounces, lowest since February 26, 2018. And this is what I'm talking about with a lot of things. We've got prices going down, we have premiums going up, and we've got our inventories getting eaten up. And there's our inventory minus 1,284,208 ounces. The inventory is walking off the shelves. So I'm going to remain bullish, and I will continue to cost average in to my favorite metals. It's coming. It says, you almost feel bad for Quakes 99 at this stage. Man can't get a day off. Nuclear renaissance news. French energy minister, the EDF plans to restart all nuclear reactors by the winter. And here's the German power prices. They are coming on back. You can't go vertical forever. Demand destruction starting to kick in to break the European power price spike. And it says 1 year forward German power price falls almost 50% this week after rising by 70% last week. Still up, though, at an alarming 460% year over year. But that is pulling back some. We've got this seasonality coming up in uranium. Now, I'm not a huge, the seasonality doesn't matter to me, but it's something to know. If things were to move, it's going to happen here pretty soon. And this is the Camco Corporation seasonality. We get a nice little move all the way up through about May. June, July, and August are the sleepy months. And now, kind of end of August, beginning of September, and on is usually a pretty strong seasonality for Camco. Here's new information. Bankers now net long on platinum. So this is the dark candlesticks here. That is commercial. Commercial's been short platinum for a long time. Now, all of a sudden, at the bottom of 2022, just when platinum was at its lowest, you could see a dramatic decline in open interest of short positions. And it's really low, and we're basically moving towards positive here very shortly. And it's positive here this past month. So they think that platinum's probably going to go long, and they usually get long a month or two before it goes positive. And I think that the timing is right for platinum. It says, just noteworthy that the European natural gas price benchmark TTF is down 37% in the past week. It is still at a large premium to oil, about $300 a barrel, constructive for oil demand. And it's not responded to recent EU political sanctions, price cap, jawboning. So we've had a little bit of a relief, a 37% decline in TTF Dutch gas. And I do think that it will level out at a higher level than back here at some point, and it's probably going to be around basically a little bit below right where it's at. And here's silver, commitment of traders. The commercial banks are now net long on silver as well. They're starting to go long in silver. You can see this dramatic decline in these short positions, and they're about to flip to go long. This is the cycle. They know the cycle. So I think it's coming for precious metals. We're just early, guys. Early's good. Coming on down, we've got CCJ versus Dow Jones Industrial. Evidence is overwhelming. Explosion is here right front of our eyes. I'm positioned, says John. And we've got a nice big bullish engulfing in the month of August. This looks great for a move higher. It looks really, really good. I like this chart. It looks fantastic. We have a long runway ahead of us. So the market conditions are right for a move higher, and the charts are also validating our bullishness in this. We've also kind of broken out of this little resistance area, and it looks good to go. Silver, worst case scenario, back up the truck line. This is the worst case scenario, back up the truck line. He took a couple of points, ran a trend line through it, and if it were to pull back, we're looking at something like 15 something bucks. $15 if it were to pull back that far, would be back up the truck line, if it gets down that far. So here's those real estate demographics. I said demographics are destiny in housing. This is the demographics or destiny housing. This week in the U.S. Census released some new population that helped drive home this point. They break down the U.S. population by age, so I calculated the most populated ages, both 2010 and 2020. So the 10 most common ages in 2010, 50, 49, 48, 47, 46, those are all the baby boomers. Then in 2020, 29, 30, 28, 27, 31, 26, 32, 35, that's all home buying years. We are coming into the most common ages are coming into home buying years, at least adulthood. It says every single age in the top 10 in 2020 fell in the range of 25 to 35. It just so happens most people are set out on their home buying journey in their late 20s and early 30s. The millennials are taking over. This demographic is driving the home prices and inflation. This is the U.S. population for selected age groups, BLS actual and projection. 20 to 29 age group past peak here, but we've got 30 to 39 that's still coming up. It peaks out around 2030-ish. 2028, 2030 aligns very well with a lot of where I think the inflation could peak as well. Somewhere in that range. It says fundamentals always matter eventually. And we've got this decline in total global oil held in inventory. It is still declining. Here's some platinum. This is great risk reward for platinum, immense upside. This is platinum itself by the US dollar. We are right here in this good, nice support zone. I like it a lot here. And then this is PLG, Platinum Group Metals, that is squeezing up as well with platinum. It is mainly palladium, but nice little chart there by Uselink. But that's what I've got for today, guys. That's what we're seeing out in the markets. That's what we've got being spoken about on Twitter. I do think precious metals are an opportunity there. We should be looking at it. I like the physical metals a lot right here. I like them a lot. Good risk reward. That's silver, platinum, and gold. So that's what I've got, guys. If you guys want, give me a thumbs up, subscribe to the channel, subscribe to the Platinum membership website in the description link below, and we'll catch you next time. This is Finding Value.